JAVIII Empire family, this is JAVII.fx. Welcome to the entries and exit class. It's very important to you as a trader. You need to know where to enter and where to exit. Now, the previous class we talked about smart money concept, right? There's a little bit more, right, to understand where the money is. I stop myself from going forward because when in the entries and exit, you need to understand where the money is, and that's what I'm going to show you. This is a support and this is resistance. You look at your 4 hour and you get a order block or support, right? And this is the bullish order block or the support that we're looking at. With this support, let's say the market is coming down. You are waiting for the market to come down on your level, right? You check back a couple hours later, the market is coming down. Now the market reaches that level, right? What smart money concept like to talk about is the accumulation phase. And accumulation phase is the first phase, right? It's where the market reaches a level and it accumulates. Entice more people so that it can build up the volume, right? What is happening when the market reaches your level now? And this is why it is important to wait. A lot of people see the support and they will instantly buy, right? So when they buy, the market will give you some sort of buy. When you see that buy, people would say, all right, we can get in for more buys. But there are times where the market does this. The people who buy right here, they will then put their stop loss down here, right? That's what's happening, don't it? Everybody who buy right here, the stop loss will be below the level. The market likes to entice people, it likes to create volume, it likes to build up the volume, it's accumulating money in the market. So people start to buy bills of liquidity, people start to put their pending stop loss orders, and also they're putting your sell stop down here. So when the market breaks this, they could probably, you know, get in for the down movement, right? So they're putting pending orders, stop loss orders, etc. there, and people are buying right here. So what the market likes to do is now the second phase will be the manipulation phase. Now I want you guys to picture all the money resting below this, all the SL, all the pending orders, all of that right here, line. Picture the lines as the pending orders and the SL building up right here. The market follows money. It's created to go after money, take it and distribute. So all the pending orders is going to gravitate to it and activate them. All the surplus orders is going to take them out. So if everybody's buying right here early and putting surplus or whatever, remember the market already wants to buy. You have your support and you know the market is going to buy. The market is going to gravitate to these because these people are entering early. Then after it comes into this, all those people who are breakout trading, thinking that the market will continue down, they are selling and selling and selling, which is adding to the liquidity. No, stop loss is up here. The market is going to come back up after manipulating that level, come back up here, right? And then now people say, okay, the market is going to buy. People's buying, buy, the market sell again, come back into that level. So after the market takes all this money down here, liquidity is building up here so again. And this is what is important with this thing, you know, right? The SL orders and everything. Now people think this is going to sell, and then now the market then buy because all the money is resting here. Now why I'm making this point, right? This is a part of the smart money perception, you know, where's the money. But why I'm making this point in the entries and exit video is because people tend to enter too early, they get trapped. People tend to enter late. All those who should have entered here, they enter here for the buy and they get a bad entry. All those people who are trying to shouldn't sell right here, they sell down here and then the market come and take them out. Now the proper way to trade this is, obviously the market is setting up for a head and shoulder. Apart from identifying where the money is, the market already took this. I want to take one side, it's going to take the other side. The market took all liquidity down here and liquidity is building right here. All this level right here is resting with surplus. This is relatively equal highs. Remember I talked about that in smart money video. When you have relatively equal highs or relatively equal lows, the market is enticing people. So think of a lot of stop loss resting here for the sell. So the market take down here already, it's going to take above there. And look at it this way. If the market wanted to sell, it would not have to go back above the level and started to trade above it. If the market was intended to go and continue downwards, it would not come back above it. So what you're going to do is You identify the relatively equal highs, right? And you know stop loss and etc. are playing above it. You're looking at the geometric pattern, and then now this is a potential inverted head and shoulder. You could say, all right, when the rejection took place right here, you could get a possible buy entry right here to take the market upwards. So this would be an entry. And where would you put your stop loss in a case like this? Your stop loss would either be below this level or below the low. Why below this level? The market already took the liquidity below here. So the market, even if the market comes below here and hit this stop loss, right, it would be safer to put it all the way down here. But if you know your thing to a level, you can put it here if you know what to look for when you go to the smaller time frame. But if not, put a stop loss below this. Because why am I saying this? You see, after a manipulation, the market will not breach it again. The market already manipulates itself, so it's not going to breach this level again. So if the market is not going to breach this level, your stop loss is safe below here. So you can put a stop loss here, entry right here, and your target would be the next support, the next resistance, etc. Right? You could use the Fibonacci tool. The market comes back down to like 50% level or so, and you get an entry somewhere right here. And you put your SL down here, right? You use, well, before you get the entry, you use the Fibonacci retracement tool from the low to the high. And the market reaches right here and start rejecting. You enter right here and you take the market upwards. If you're using the Fibonacci retracement tool, then your stop loss should be below the 88% level or below this low right here. And of course, hear me talk about the Fibonacci expansion part of the Fibonacci retracement tool. You probably target the 0% level, the negative 27 and the negative 61.8 level for your take profit, those three areas, right? So when the market reaches a support, look out for the accumulation of the orders, look out for the manipulation of that level, and then know a way to enter so you can get the distribution. The market takes money and it distributes. The market seeks after the money, it seeks after liquidity before it makes the distribution. They need to identify these things before. And one way of identifying these things is that when you see relatively equal highs, when you see a clear support, the market will manipulate these things. Look at this now, the breakout structure. Everybody likes to say this, but you need to know how to trade it properly. The market does something like this. When the market does something like this, what you're thinking, breakout structure, don't it? Call that BOS. You're saying, alright, this is a switch of, trend. This could very well, this sell could be very well be an order block. No. When you hear me talk about that bullish order block, what you're thinking is that the market should come back to trade inside of the order block before it buy. So if this right here is your order block, the sell that took place right here, if you're picturing from using the candles, right? And this is your breakout structure, which creates the order block now, the buy candle. And then when the market comes back down, you want to enter for a buy down here. Simple as that. And you want to identify this, the 1 hour, the 5 minute, the 15 minute, the 1 hour, even the 4 hour. When you see these type of things, you buy it. You buy it. You know why? You have so many things that's showing you a buy right now. You have an inverted head and shoulder, potentially forming. You have a BOS, which is a breakout structure. It break your trend line also. Also, you could see something like this. If you see this on the RSI, where the market comes like this, on the RSI, the market creates a lower low, but on the RSI it creates a higher low. That's an indication for a buy, right? And where you get your entry is down here, or when the market comes back down to test the level or creates the inverted head and shoulder. That's where you get your buy. One last thing that is very, very important is something called a Quasimodo, right? Quasimodo, you guys can even look this up. Quasimodo is something that is highly used in trading to get entries, spot entries. It's when the market is selling and the market creates a lower low. Then the market go and create a higher high. This is a reversal pattern with candlesticks called Quasimodo. This is very important because when the market creates a lower low and then it creates a higher high, when the market comes back to test right here, this right here, this same support, it is going to buy. it is going to buy. So we have a Quasimodo, low low, higher high. You expect a buy. 1, 2, you have the market went, accumulate, manipulate, then no, it then went above to start the distribution. It creates a breakout structure right here. Say expecting upon the retest of the level, the market will buy. Then you probably see something on the RSI where the market creates a higher low instead of a lower low. It's a reversal pattern. Remember, all the things come together. You're seeing these things. Your entry would definitely be right here. Stop loss be down here, and you're targeting some resistance or something above. Remember, Quasimodo, don't forget that term. Don't forget these regular retail way of trading, because smart money concept is not just about going against retail perspective. It's about using retail perspective to your advantage. So you have the inverted head and shoulder. You use the inverted head and shoulder to your advantage. Look out for the accumulation and manipulation and anticipate the distribution, but get in so you can be a part of that distribution. Look out for the breakup structure. Look out for the RSI. Remember the Quasimodo. These things are very important for your trading. This will help your trading. Let's look at a different one. We still have a support. The market is doing something like this. Right? Market sell. You have some people who start to buy. Then the market comes back down. And then they start buying again. Remember this? The double bottom. Everybody likes to trade this double bottom because it's showing, oh, the market is respecting a support. The relatively equal lows. Yeah, people love that. It is going to buy because it's showing a double. Remember, following up from smart money concept, where is the money? The money is below here. If you can picture all the stop loss resting below this, it's equal. People thinking it's not going to breach. The market did not break this one. So why don't you come back and break it again? That people are going to say. So people are going to put them stop loss below this, right, and they're going to put it tight. You know what the market is going to do? Remember, the market is designed to go after the money and take it. So you have the breakout traders. Remember, I talk about breakout, middle trend traders. Those type of people the market entice. The breakout traders having pending orders. So if the market sell, they want to be entered in the sell. You have the people putting the stop loss down here. All these orders resting down here is going to add to the liquidity, and the market want liquidity. So what the market is going to do? The market is going to go in that beat that huge dense area of liquidity. The market is going to seek into that, and all those people selling, they are going to be enticed to sell. And then when the market entices them to sell, the market rise above. So one or two things can happen. You see, it's either the market continue to sell, right, or the market rise above, right? It's one of two things generally. But chances are, the greater probability of the market continue to sell is sort of low. And it all depends on what chart you're looking at and what time, right? When the market breaches an area of dense liquidity, it tends to reverse, right? Remember smart money, buy below all lows and sell above all highs. So we have two all lows right here. The market is going to buy when it reaches those. All the money that took place, the market take right here, the market is going to then take it and then distribute upwards. So after distributing upwards, you could then see something like this. You know, the breakout structure, come back to test the level, and then you have the potential rise in the market, right? This is something that is totally possible. Always careful when it comes down to double bottom, right? You need to know how to trade this. Before I understand this whole smart money and everything, I then thought double bottom made sense as well. But sooner or later, you're going to realize that the market, after buying, you know, forming the second leg of the W, it is going to breach it. The entry will be down here. Entry will be right here. These are possible areas to enter. Anywhere in this level of support. After the market manipulates, it accumulates. This is a big old accumulation. After the manipulation, then you get the entry right here, or you get the entry after the manipulation. Of course, when there's rejection or a level of sub-level down here where you could find after the manipulation. Even though you see the market is selling, if the RSI is showing you something like this, you know, the market created a higher low, right, on the RSI, but on the regular main chart, the market created a lower low. You could enter right here too, right here, because the market is going up. If you're scared and don't want to be a proactive trader, you rather be a reactive person, when the market comes back to test this, you could enter, you know, for the buy.